Now to your first dollars and cents of 2024. January is here and the holidays are behind us, and now many of you are facing the cold shock of your credit card bills. If you overindulged in the holiday spending, you aren't alone. U.S. credit card debt has now surpassed $1 trillion. If you find yourself struggling to pay off your bills, a local expert tells me how a personal loan could help you manage your credit card debt. Like a splash of ice water on your face, getting your first credit card bill after the holidays can be a shock to the system.
Sometimes where people aren't even able to necessarily, make the minimum payments or get those cards paid down because they have ran up that debt.
One option to help you get your spending back on track this new year is a personal loan.
You then take the money that the company is giving you in this personal loan, apply that money to pay off your higher interest credit card balances.
Instead of juggling multiple credit card payments every month, use your personal loan to pay off all your credit card debt in full, leaving you with one consolidated loan that could also save you money over time.
An interest rate on a high interest credit card might be 16, 18, 20% plus, which I'm not afraid to use the word astronomical. I mean, those are very, very high interest rates.
Compare that to the interest rate on a personal loan, which is typically half that, at around 8 to 10%.
The short answer is yes. I mean, they're the companies and the financing companies that are actually issuing these personal loans are going to check credit. They're going to check, verify income, similar to what a credit card company will do.
Using a personal loan to pay off your credit card debt is not the same thing as being debt-free.
That should, in theory, free you up to have a little bit more cash flow because you're not paying so much in interest as what you might be with these higher interest credit cards.
Spending within your means still matters.
If you're not willing to examine yourself and some of your financial habits, you very well could come back into the same situation that you got yourself into to begin with.
Being late on credit card payments is a serious matter and could hurt your credit score. Research from Dynasty Financial Partners shows credit card delinquencies are rising. Young people are really being hit hard by this. So keep in mind, this spike has happened during a strong labor market. Experts say if the unemployment rate were to rise, we could see delinquencies rise even further.
And with that, I know folks may be wondering, are there any other risks with personal loans?
Yeah, that's a great question. Always remember that taking on debt does come with risks. So remember, personal loans can come with fees too, like an origination fee, late payment fees, and insufficient funds fees. So make sure that your personal loan has lower interest rates than your credit cards, and have a plan to pay off your personal loan without going into new credit card debt, or else you could really be worse off than when you started. So be careful, everyone.
Happy New Year, right?
Yes.
So the focus begins on this type of stuff.
It does.